Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the S&P 500. I'm going to cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only and doesn't take your personal situation into account. With all of that said, let's get into our first chart. So I've got the S&P 500 up on the screen, and I think for a lot of people are probably finding this current period quite difficult. And the reason for that, of course, is we've had 5 months. We've had 5 months of steady, virtually pain-free gains, and now we've got a 5% pullback, which has taken hold just in the last few weeks. So when you get these situations, you get people wondering, is there more to come? Is this the start of something bigger? Now, last week I was telling you about the frequency of pullbacks. And on average, there are around 3 pullbacks of 5% each year. So should we be surprised that we're getting a pullback now that is currently around 5%? And I think the answer to that has to be no. And don't forget that in the 5 months prior to the recent top, the market had put on 28% in just 5 months. So that's a big rally. So of course, there was always going to be a meaningful pullback at some point. That was an inevitability. And of course, the 50-day moving average. So I've got the 50 and the 100-day moving averages on this chart. And of course, that 50-day moving average was going to be revisited at some point. This was a lengthy run above the 50-day average without coming back for a retest. We've now got that. It was always going to be something that was going to happen. It's interesting when we look back. We look back at past bullish periods. So just come back here. Let's just come back to 2021. Come back to the 2021 period. What we see is that there are multiple pullbacks back towards the 50-day moving average, back towards the 100-day moving average region. They're common. They're common, and they're common in rising markets generally. They can happen, as you can see here, they can happen every few months. It's not an unusual occurrence to get a market pulling back to moving averages. We can go a bit further back in time, and let's go back to 2017. And it's a different bull market. There were different economic and fundamental factors impacting the market, but it's the same story. You get these pullbacks to the moving averages along the way. The market then stabilizes and rallies again. It's all part of a bullish market, is how they function. And just to show those two examples aren't one-offs, we can go back further. Let's go back to 2014. We can keep playing this game. We can keep going back through time. And during bullish trends, it's the same outcome, in that these pullbacks, these consolidations along the way, they just help keep the advance sustainable, help it keep on rising. Now, that's not to say that this current pullback has to go the same way. Nothing says the market has to stabilize at current levels and go up again. Of course, it may not. Every period is going to be different, and no one knows where the final top of a move is going to be. But as I explained last week, I think our base case should be that a trend is upwards until we have clear evidence to the contrary. And at this point, a 5% pullback to the moving averages, well, I just don't know how we could say that was evidence that there's a major top in place and significant weaknesses is about to unfold. At this point, the evidence just isn't there to support that. So, having said that, how do you play this? How do you deal with the current market price action. So I'm going to get to that right in a moment. But first of all, if you're getting some value, please hit that like button, leave a short comment, hit the subscribe button. Just tells YouTube you're watching, even if it's just, hey, thanks for the video. YouTube will then see you're engaging. It shows other people. It helps me, helps the channel heaps. So please do those things. So what do we do here? I think the S&P 500 could be in for several months of consolidation, maybe 2 months, maybe 3 months. I don't know, but I think several months of consolidation is certainly a possibility. It probably needs, I think any consolidation probably needs to be in some proportion to this rally we saw from the October low. So it's a big rally. It's gone a long way. So a consolidation needs to be somewhat proportional to what the previous price action was. Looking at the S&P 500 just on its own, I think it's like, if I look at this independently, just this one chart, it's not inconceivable that the pause could be shorter. It could keep rallying maybe within a few weeks' time. But it's when I look at the other indices, because of course these markets are a big puzzle. We're trying to put all these moving pieces together. When I look at the other indices, that's when I think that a larger pause is probably more likely. So take so this is the S&P 500 capitalization index. Let's have a look at the S&P 500 equal weight. When we look at the equal weight, it's down around 6% from its high. I think overall, when I look at this, there's been more technical damage. The pullback is deeper. It's come back to this congestion area that developed from mid-December through till February. It's come back to that congestion point, and so for me, this suggests to me that what we're seeing the market correct. We're seeing the market correct this whole move from the October low, not just the last 2 or 3 months. As like, if you look at the S&P 500, maybe it's correcting a shorter part of the advance. Come over to the equal weight. Well, we're already back to where we started the year. So I think it's suggesting there's a larger consolidation underway. And the same goes when we look at the Dow. So calling up the Dow Jones Industrials. And so it's given back most of its gains for this year. You can come back to the start of the year, and the Dow's pretty much back to where it began the year. So I think it's correcting the whole advance from the October low, not just the last 1 or 2 months. And that means that it should take longer than a few weeks to work through. So if it's going to be proportional to correcting a 5 months advance, probably doesn't happen in 2 or 3 weeks. Probably takes maybe 2 or 3 months at a rough sort of guide. The Dow actually gave us a bit of a warning sign last week, and we're talking about that. We're talking about how the Dow had already started to lose its footing, unlike the S&P 500 and the NASDAQ, and now we've seen that weakness in the Dow follow through to the rest of the spill over into the S&P 500 and the NASDAQ. And that's why we should always be looking at across the indices, not just one, not just the S&P 500, but look across everything, and because it can give you clues to the overall or underlying health of the market. The Russell, just lastly, looking at the Russell, the small caps, and they've lost their bullish setup for now as well, with this pullback really starting to gain some momentum. They're back within the range, so we can just compress this a little bit. We can see this big trading range that they spent something like 18 months in. Start to get the Russell breaking out from there just over the course of this year. But that bullish setup has now been put on hold with the market coming back. It's now back within the range. So this breakout is now, for now, it's null and void. If anything, you call it a false break. We're back into the consolidation sort of mode. We've got to see how this price action develops from here. I think this is going to take time to stabilize and rebase. And if it does chop around for a bit, maybe it can re-engage to the upside. I think that would still be my favorite view, but I think it takes time. I'm still using wide trailing stops across my stocks, and my aim with that is simply try and see off a pullback, try and stay in profitable trades. And I'm also selling stocks that are hitting their exit levels. I'm not holding and hoping that they're going to rebound, but it's like they hit the exit level, get them out of the portfolio, move that money into cash. As I said last week, I think we can take our time with buying and see what develops from here. I'm happy to play it defensively until prices start to stabilize. And so I think we might leave that there for this week. Thank you for joining me. Hopefully that's been interesting, giving you a few ideas about the current setup in these markets. I look forward to coming back and doing it all again next week. Until then, bye for now.